I'm Charlotte McLeod with investingism.com, and here today with me is Justin Huhn, founder and publisher of Uranium Insider. Thank you so much for being here. Great to have you.
Good to see you again, Charlotte. Thanks a lot for having me on.
Really good to be catching up with you. And as I was looking back, I saw that the last time we spoke was all the way back in February. So really quite a lot has happened. We've got a lot to go over. And I thought we could start at least briefly setting the stage with, I know about a month ago at this point, you went to the World Nuclear Symposium event. And that's a little ways away at this point, but maybe just some brief takeaways that you had on sentiment takeaways to set the stage.
Sure. This conference, as far as I can tell, was one of the more important conferences, partially because of everything that's happening in the nuclear world right now, but also because it took place basically at the depths of the terrible sentiment over the summer. I've been following this market for about 7, pushing 8 years at this point. I've seen a lot of volatility, some screaming rallies, some extremely difficult to handle pullbacks, and terrible sentiment on multiple occasions. We've got 1 or 2 of these 30 to 50% pullbacks every single year since I've been following this. And this year was no exception. But I would argue that the sentiment in the sector was worse than I've ever seen it this summer, which is extraordinary. So despite the fact that, the work that we do, especially when it comes to digging into the nature of the physical uranium market, which is really, the core of the supply and demand for any commodities really should be the core of the thesis. Now, of course, there's individual company specifics that may influence, a long or a short position, whatever it might be. But for the overall sector, the overall thesis, you want to know what's going on for the commodity. Excuse me. And with that said, throughout the summer, nothing really had changed fundamentally. It still is, although that's shifting pretty quickly right now, a very slow year in terms of term contracting, a very slow year in terms of spot market volume traded. With that said, last week was the most traded spot volume for a single week in 2.5 years. So that picked up significantly. Term contracting discussions and actually contracts being inked is starting to heat up. We're seeing the spot market tighten. But throughout the summer, nothing really changed about the fundamental thesis besides the fact that it was just very quiet. And apparently uranium speculators don't like quiet markets. And I've seen this over and over and over. If you have a period of weeks, and in this case, months of the spot market doing nothing, people start to get exhausted with that, especially you've got a backdrop of AI and tech flying, gold and silver starting to heat up. So all of these, there's opportunity cost in sitting in a quiet market that's like slowly retracting. Then, of course, we had the yen carry unwind that was kind of like the nail in the coffin. That was early August. It kind of hit everything, but it was sort of like the capitulation low for uranium stocks. Retested that low in September. But my visit to WNA was phenomenal. It was one of the most juxtaposing experiences of my life because it was extremely positive. There was a flurry of meetings. Everyone in the industry was there pretty much. The conference sold out. So it was absolutely frantic in terms of trying to connect with as many people as possible during the 3-day period. And that was very successful. I had very high-level meetings that gave me important insights that I was able to share with our membership and to some extent publicly as well. And basically, everything was brilliant at the conference. I came away with the feeling that I'm not missing anything. That was really important. And that was the general, let's say, feeling amongst multiple other investors, fund managers that have allocations to uranium or specialize in uranium was like, all right, are we missing anything here? Or is this literally just the equities doing what equities do? And that was the case. Don't feel like we're really missing anything. And came away with understanding that the term market was going to heat up, especially starting now in October, because the U.S. utilities have a new budget as of a few days ago with the beginning of the fiscal year. So it was a sincere recognition that the market had it wrong. And that was something that I was able to communicate to our membership literally on the last day of WNA, which perfectly coincided with the low of that pullback. So, and since then, the stocks are up about 35 to 40%, which has been a nice run for the month of September into, excuse me, this first week in October. So we've had some brilliant news come out, but yes, the conference was very confirming for the long-term, long thesis for the sector. Very confirming for the growth of nuclear. A lot of talk about Chinese demand and inventory building. A lot of talk about AI and data center demand and tech companies de-risking not only the existing fleet, especially in the US, but looking at new builds. We can get into that more if you like. Phenomenal experience, and came away with just much, much improved confidence, especially in the near term. Long-term confidence has always been there because this is exclusively what we cover. So we know what's going on pretty much. But the near-term confidence, what's going to happen to end the year, came away from the conference feeling very, very confident in that, in a strong move to end the year, and positioned for that.
Okay, thank you for going into that. I think it's good to get that big picture overview. I've talked to a few other people who were at that event, and definitely it's what's coming through is that positivity that was there in contrast to what was going on in the rest of the market. And it helps me to hear you say, okay, this confirmed your beliefs. The market was a little bit wrong at the time, and now we're coming back. So with all of that in mind, I thought we could get just a little bit more big picture context before we start to go into some details. When we look at supply and demand so far in 2024, how is the balance stacking up?
As far as we can tell, we're going to end up with somewhere around 30 to 35 million pounds short on the supply side and this is from literal structural demand from the burnup rate of the world's reactor fleet compared to what's coming out of the ground. So you can end up, so we're probably looking at about 180 million, maybe 185, depending on where you make your enrichment tails assumptions in structural demand this year from reactor burnup, probably 150, 155 million in supply. Then you have a little bit of secondary supply. There's basically no underfeeding coming from Western enrichers. Iran, Urano, no underfeeding whatsoever. Russians are certainly still underfeeding. A lot of that is the Russians are short uranium, and they have the biggest export book of even bigger than the Chinese. I think they're building 18, 19, and possibly even more reactors right now because there's so many announced happening in India right now. And some of their reactors they're building are these smaller Russian VVERs. But so all of that said, Russian underfeeding is mainly staying in the east, maybe 12 to 15 million pounds annually coming out of enrichment underfeeding that's not in the West. It used to be 25, 26 million pounds a year just from underfeeding. And that's basically been chopped in half. So you have some secondary supply there, but you also have secondary demand. You have financials buying. So Spot has bought, I think, 2.5 million pounds this year. There's been other hedge fund buying earlier in the year. They kind of reappeared in August, buying some of the lows. So there's been financial demand. There's also inventory restocking, which you can count as secondary demand. It's demand on top of what structurally is being burned up year over year. So overall, structurally, 30 to 35 million pounds, depending on how aggressively to end the year, inventory restocking happens. We could see that blow out even more. And year over year, there's a couple of adjustments that need to be made in the supply and demand calculations. So obviously, we're seeing some supply respond, right? We're seeing the Uzbeks are ramping maybe an extra 500,000 pounds a year going out to the end of the decade. Kazatomprom is attempting to ramp. They will be able to marginally, not hugely, but an extra 1,000,000 pounds, maybe two, kind of as each year passes. US ISR operations are, the gears are turning. 500,000 pounds this year, maybe 750,000, maybe 1.5 million next year. So all of these things they're slowly incrementally adding to supply, but the big projects that are needed to balance the market are years away and are definitely not confirmed on any sort of reasonable timeline. Demand, however, has two things going for it. It's starting to kind of blow out to the upside with all of these fundamental developments, and we're seeing life extensions across the board in the United States. There's a couple of outliers that are seemingly sticking to their phase-out plans. So that would be Taiwan just shut down a reactor and then, of course, had to turn down data center deals because they didn't have the juice to power them. like literally the week after that. Spain appears to be sticking to their guns, although nuclear is, I think it's 25% of their grid. So will they actually be able to shut them down? Hard to say, but still an ideologically driven phase out policy for Spain. Whether or not they shift, I don't know. We'll have to see. Besides that, everybody else is either de-risking and life extending their existing fleet or building new nuclear power plants. So there's actually 67 new reactors under construction right now. About half of those will hit the grid in the next 3 years. So demand is growing significantly. And if we end up seeing new build announcements, especially in the West, that are even remotely close to approaching these goals of tripling nuclear globally by 2050, these COP28 goals, which the United States Department of Energy seems to be doing everything they possibly can to support this happening. Excuse me. I think we're going to be seeing new announcements for AP1000 builds in the United States in addition to SMRs. So if we start to see builds accelerate in the West, the demand picture is just going to grow significantly. So putting that in contrast with, excuse me, the utilities doing what they can to buy time in a difficult market. Prices are very high compared to what they were last year. They're still very low, historically speaking, inflation adjusted to what they've paid during bull markets for the commodity. But utilities have been flexing up contracts. They've been pulling forward material from Russia. They've been buying a little bit EUP from China. All of these things have allowed them to largely step out of the term market this year. A lot of uncertainty around Russia. That's not just for the United States. The ban, the waivers, that's specific to the United States mostly, although there's some tricky dynamics to European utilities who might have Russian uranium shipped to the United States, the fuel fabricated here and then sent back to Europe, and that's getting complicated with the ban. But also over the past few weeks, Putin has come out saying we are looking into critical minerals that we are exporting to our foes, and we might consider cutting these deliveries off to unfriendly countries. And that wasn't just a statement. Since then, his administration has been looking more deeply into this. And I think there's actually a decent chance that Russia could cut off exports of some critical minerals, including uranium. Certainly that would affect the United States and the UK 100%. They're the most clearly unfriendly countries of Canada also, but I don't think they deal much in Russian uranium. Their entire fleet is heavy water, doesn't need to be enriched. So, but if the French are included in a ban of Russian material, they are highly, highly exposed currently and going out to the end of the decade and beyond. So that would be a enormous disruption to the nuclear fuels market if they end up doing this. And I think the chances are decent that they do. Of course, we're a month away from the election in the US. It's pretty much understood that if Trump were to be victorious, he would probably end the conflict in Ukraine, right? So this may or may not pan out, but I can tell you that the utilities in the US and in the EU are concerned about this potential development. And this is something that UXC has been warning the utilities about for more than 2 years. While we might enact our own voluntary bans in the West, Russia at any point could just be like, dude, we're at war. What are we doing fueling your reactor fleet? So, and you guys are benefiting from that. So watching that closely, all of that is to say the market is going to be imbalanced for many, many years. And it only reaches a point of maybe almost balancing 29 or 30 or 31 if some of these very large projects come online. If NextGen's Arrow, Denison's Phoenix, Global Atomics DASA, Kazatomprom full ramp up with a new sulfuric acid facility, if all of that happens, then we reach a point in time of potentially almost balancing. But then we get into the early and mid 2030s and the decline rates are huge for the existing mines, for Rossing, for Husab, for Langer Heinrich, for half of Kazatomprom's projects, for Cigar Lake Phase 1, even Cigar Lake Phase 2 getting into the mid 2030s. Like decline rates are huge for the existing mines. So when you hear Kazatomprom say, we need another Kazatomprom, that's not just lip service. Like they actually mean that. And if we're going to be expanding nuclear anywhere remotely closely to what these goals are, we're going to have to see an enormous supply response, and that is just not in the cards yet. So we have a very interesting setup for the next few years at least.
Okay, I think that again that helps us get a good look, big picture at what's going on here. So thank you for going into that. And now I'll try to follow you down some of the different paths that you had mentioned. And I think where I'll go first, just because it was one of the most recent things you're talking about, is the comments from Putin on limiting exports to the US, possibly other countries. So on the US side, I guess companies should technically be trying to limit themselves from getting material from Russia, but we have the waivers. So I was wondering about the waiver situation right now. How are those stacking up? What are the things you would point out there?
So we know for sure that there's already been the first set of waivers granted. I believe there's probably going to be a second set of waivers granted. The first set was granted to Centrus on behalf of kind of like acting as a broker for multiple utilities. The DOE certainly did not want to impinge upon any domestic reactors' ability to actually fuel their reactors and operate, let's say for the next year and a half. Going out, it's going to get more difficult. The utilities are now having to not only show the critical nature of the next delivery coming from Russia, but they also have to show their order book to the DOE and prove that they don't have other options being delivered upon. So deliveries from ex-Russia going out that could theoretically take the place of a Russian delivery that they're trying to get a waiver for. So in our estimation, waivers are going to be granted largely for this first and maybe second and maybe third delivery going out, let's say for the next 18, 24 months. Beyond that, it's going to get tricky. And then, of course, it's completely cut off in 2028. So and like you mentioned, you would think that the U.S. utilities would be seeking supply outside of Russia and trying to cover their bases. And a lot of them are. So to speak very broadly, generally about the utilities in the U.S., and they're certainly not all the same. There's 2 or 3 utilities that are extremely exposed to Russian supply. There's a few that have zero exposure to Russian supply, and then everywhere in between. But to speak generally, they have done what they can to pull forward material and legacy contracts, or flex up. So, and that's mostly uranium, sometimes UF6, but they will try to get as much material as they can at the partially fixed price from a contract signed 2, 3, 4, 5 years ago. So that helps. But of course, if you're getting contract deliveries for uranium, you've got to buy conversion and enrichment, which are crazy expensive. If you're getting UF6, you got to buy enrichment. So you've seen conversion and enrichment prices go through the roof, and uranium is going to follow, and has started to follow, but it hasn't moved like conversion and enrichment have, and it will. So they've flexed up, they've pulled forward. Last year was the largest amount of deliveries from Russia in more than a decade. So they've done what they can to accelerate future deliveries from Russia last year, and to some extent earlier this year as well. And they've been able to draw down a little bit of inventory. They've been able to buy some spot EUP here and there. It's very expensive, but they've pulled a bunch of little levers to buy a little bit of time with the uncertainty of the waivers process. So as this process kind of pans out and becomes more clear, that uncertainty starts to go away. And it's interesting, more so than the pricing environment, which certainly affects the way that the utilities behave, but more so than price is uncertainty. And when there are uncertainties in the market, it definitely slows things down for utilities in terms of term contracting. When things are very known, it's an open global market. To some extent, when that was the case, we still had a decent amount of above ground mobile inventory. So there were a lot of carry trades, smaller volume contracts, in addition to spot market purchases. Those options have largely diminished. There's been a little bit of carry trade volume happening in the past 6 or 8 weeks, which is chopping some wood in the spot market. But at some point, there's no avoiding the long-term contracting market. So they're going to have to come into the market en masse. To speak specifically about US utilities, the electricity demand is skyrocketing here, and they're making a lot of money. Some of these utilities are signing these huge power purchase agreements, Talon Energy, Constellation with Microsoft, making a lot of money selling electricity. That environment is going to remain and continue. And when the reactor operation lifetime is de-risked and understood, it's going to be operating, for another 10, 15, 20 years. And the profit margins are increasing on the product of that reactor. We're going to see larger volume, long-term contracts signed at these prices and higher. And to wrap this all up into a fine point, to have very low volume contracting and have the price continue to rise is a very, very important signal. So the last time we spoke, Charlotte, long-term uranium was $70 a pound in February. It's 82 here right now. So it's up since the beginning of the year by 20%, even though we've only contracted 54 million pounds officially year to date. So demand pulled back temporarily, and when that happened, the price kept rising. It's a hugely important tell. When the demand comes back in, which it's starting to, and volumes increase spot and term, the price is heading higher. We're starting to see the early signs of that. I think, honestly, we're on the cusp of a very, very large move, and it's likely going to happen in the coming weeks.
Okay, I think that does wrap it up into a nice, easily digestible point. I have one more question on the utilities. So you mentioned they're kind of trying to put the brakes on now as much as they can. They don't like to operate when there's so much uncertainty. But realistically, how much can they delay? I know that they're not buying material for tomorrow, for example. They're buying far out. But what does that look like?
For sure. So utilities generally are usually covered in the near term, and they always are, right? So most utilities don't have super near-term needs. Although, interestingly, there are some RFPs in the market with deliveries as soon as 2025. But most utilities are well covered across the fuel cycle for 2025. 2026, you get into 2027, it starts to come off a little bit, 2028, even more. You got to 2030, and utilities are about half covered. So late decade into the early 2030s is really the period where utilities are aiming to cover right now. And the interesting part is the supply that's expected to come on during that period of time has yet to be sold. So, for example, NextGen hasn't signed a single contract. Right, they're moving towards they don't have the permit yet to start construction of that mine. So until that happens, they're not going to be looking at contracting. Utilities are not going to be contracting with them, assuming it's going to come online when a shovel hasn't hit the ground yet. So you have an expected supply response roughly 28, 29, 30, 31, that realm between all the projects I already mentioned. But that supply hasn't been sold yet and isn't available for sale right now. So utilities, in some cases, might believe that these projects are going to come in and sort of satisfy the demand picture on the supply side. And that's keeping them somewhat out of the market, but not really. But utilities are not going to draw their inventories down below a certain level. So the US utilities inventories have largely been relatively flat for the past few years, around 2 years on average. It increased a little bit last year. That had to do with that pulling forward Russian material largely and flexing up. So inventories bolstered a little bit, but they will not draw down largely below 2 years of inventory. The EU utilities are around 3 years of inventory. So they can't really delay much longer. These flex provisions in contracts is a buyer's market element. So as the price has started to rise, as the power in negotiations has shifted from the buyer to the seller, it's 100% seller's market right now. These flex provisions largely do not exist in new contracts and haven't existed in new contracts for the past 2 to 3 years. So as the old contracts start to roll off and get delivered on, which has been happening, of course, and the newer contracts lacking in flex provisions start to be delivered on now, next year, 2026, 7, 8, that ability to flex up goes away. And so that lever is diminishing. Pulling forward a Russian material is kind of over. They're not going to get waivers to get more material than what they've contracted for. So that's sort of over specifically for the US utilities. And then the last element is almost kind of like a psychological element, which is because of the inventories in the industry, not only held by utilities, but held by converters and enrichers and across the commercial fuel cycle. Because those inventories exist, there's always a little bit of flexibility, right? Until and unless they wait till the very last minute and the coffers are dry. That doesn't usually happen. So when the market makes outsized moves, you as a utility fuel buyer, you have the ability to kind of step back because you've got a little bit of inventory, kind of always, right? So a move from $55 last August to 106 in January, now pulling back only to 80. It's a really, really big move, especially the doubling of the price in 6 months. So that caused a lot of players to go, okay, that got a little bit out of control. I'm going to step back now and see where this settles out. And there's plenty of, so utilities largely are being operated by career people. Like these are usually older generation guys and girls that have been in the industry forever, 20, 30, 40, sometimes 50 years. They've experienced multiple cycles. All of them remember 06, 07. They all remember the Cigar Lake flood. They remember the overhanging demand growth picture of China building. We had a balanced market supply and demand during that period of time, which is very different from right now. They all remember the hedge funds coming in and buying uranium and pushing the price up. And there were utilities that signed contracts at $80, $90, $100 a pound, even though that price was largely, in that case, being driven by China buying and financials buying. So there was a major broad commodities bull market at the time also, and just all markets were moving up before the GFC, right? Everything, it was just a crazy bull market across the board. But the utilities remember that. They remember being caught up in that frenzied buying environment. And you look back at that chart and it went like this, and then it went like this. It just shot up and it came right back down. And that's their memory. This was driven by a speculative frenzy and it crashed right back down. And some people signed contracts at $100 a pound, and 3 months later, the price was at 70. And so they don't want to get caught up in that again. So when they see the price go from 55 to 106, a lot of them step back, sit on their inventories, do a little carry trade nibbling, which they've been doing in the last 2 months. But they're going to wait and see where it settles out. And now we know where it settled out. When it was dead quiet, June, July, August, dead, the price didn't collapse. And all of them can see that. And now we're starting to see utility after utility come back to the term market contracting table. And they're going to have to sign these prices because the producers are not budging. They're not budging. You can see that in the consistently rising term price. So there's been some headbutting. It's a tricky market for utilities right now. It's not a market they like. Most of the experience, if you've been a fuel buyer or have worked at a nuclear utility for the last 20 to 25 years, 90% of the time, it's been a favorable environment where you can pick up the phone, call your boy in Russia and be like, hey man, I need uranium conversion and enrichment and fuel. And boom, okay, done. Cheapest prices you can get. Above ground mobile inventory, very liquid, largely affordable fuel prices for most of your career. The exceptions were 05 to 07 and the last 2 years, and especially right now. Yet if you inflation adjust the current prices across the fuel cycle, we are well below, especially for uranium, well below. Inflation adjusted 07 peak was $200 a pound, and here we are at 80. So there's slow acceptance of these big moves in price. And that slow acceptance, I think we're nearing the end of that quiet period. And there's plenty of evidence in volumes traded spot and term over the last 2-3 weeks to suggest that that is the case. The end of this period of holding back, seeing where it settles out. We know where it settled out. Now it's time to step back up. And there's no reason not to. Utilities are making money. They're profitable at these current prices. They're profitable at $150 uranium. So we're going to see a competitive environment for limited supply. That's what's coming next. It's one thing to just be like contracting replacement rates, 180, 185 million pounds, especially if we see rising transactional and rising operational tails, which we will. Transactional tails have already been high for the enrichers. Rising operational tails increases the amount of uranium that's needed overall. So you have to plug in an enrichment tail assumption to get that 180, 185 million pounds based on the total gigawatt operating capacity in the world. All of that is to say, demand's coming back, prices going higher. There's not enough supply, especially for the next 2 or 3 years. I think we're going to see a bidding war for limited supply. Not going to happen tomorrow, probably not going to happen next month. In that 24 to 36 month period, it's increasingly likely that there's going to be sort of a panic moment where multiple utilities are going to be fighting over the limited supply. I think that's coming.
Okay. And I know you're not a big fan of doing price predictions, but is there anything you can say about what's coming as we continue on into 2024, into 2025 for the price? And I guess a side note, one thing I've been hearing from others right now is it's really important to distinguish between spot and term market if you're an investor looking at this market.
The spot and the term market are different markets, but they're also connected. Especially in something like a carry trade where you have a trader selling midterm pounds to a utility in a contract going out, let's say, 12, 24, maybe 36 months, and then buying in the spot market. You also have, the traders, to quote Grant Isaac from Cameco, the traders are the connective tissue between the two markets. So as you see, especially when you see equities start to go risk on spot trading near NAV, which they have been for the last about 10 days, which is great. You'll see much more trading activity happening, and the carry trade. So to put it simply, if the term market, the term price going out like 3-year forward, 5-year forward, right? So if you actually look at, let's say, let me look at the month-end prices for September 30th. 3-year forward, 94, 5-year forward, 101, okay, for uranium. So $94 is what they're saying you can sell uranium for 3 years out. So if you can buy uranium at 79 or 80 or 81, and the cost of capital and the cost of storage for you as a trader is low enough that you can arbitrage that and sell to a utility for between 90 and 95 going out 2 to 3 years, you'll do that all day long. So that 3-year forward price and the rough pricing going out 2 years, 3 years, 4 years, whatever it might be, that creates a floor in the spot price. Because anytime the spot price drops to a certain level where the trader they've already got this all calculated, their cost of capital is going to be 6, 7, 8%, whatever it is. They know their storage fees at the conversion facility. They deal with suppliers and utility customers on a daily basis. So they know, okay, I can sell 500,000 pounds to Duke or 2027 delivery. I can sell it to it around this price. As soon as the spot price maybe drops to 81, whatever it is, I'm in there and I'm going to buy it and I'm going to sell to them. I'm going to make my profit. So the term price, and not the official term price for right now, which is 81.82. That's the low offer of the previous month. Nobody is selling term pounds there. That roughly represents the floors in negotiated contracts for future deliveries. The real term price is the 3-year forward, 5-year forward for a carry trade. So the term price that you can sell at going out a couple of years literally creates that floor because of the traders that can arbitrage that difference. So that's why we're not going to see $60 uranium maybe ever again until this market peaks and maybe crashes with some technological innovation 10 years from now. Like, who knows? Who knows what can happen on that timeline? But in the meantime, we're not going to see prices collapse in spot because the term price keeps grinding higher and the demand is so consistent and growing and easy to model that it's very easy. This is a complex market, but it's very simple to understand these dynamics and to say with confidence, we're not going to see the spot price fall. Yeah, it'll go up and down $1 here, $1 there, but the demand side is blowing out to the upside and seeing the term price rise and hearing that the ceilings, and this is to answer the first part of your two-part question, the ceilings are in the 120s, 130s, and higher for delivery going out late decade and beyond. What that tells you is that a ceiling is a price where a producer is going to be making a ton of money at that price, but it's also protecting the buyer from a price beyond that. So if the buyers and the sellers are signing contracts, 80 floors and 130 ceilings, that's telling you basically that the buyer is expecting the price to be higher than that, and they want protection at the time of delivery. So if the price is going to be 180 in 2027 for this contract delivery period, and you negotiate a 130 ceiling, basically what you're saying is, we think it's highly likely that the price is going to blow out to the upside beyond this ceiling, and we want some protection. That's what a ceiling is. And it's a price where even if the producer expects, or a developer expects the price to be beyond that at the time of delivery, they know based on their feasibility studies or their current operating costs that they're going to be printing cash at that ceiling. And that's where they're settling out. So the ceilings in the contracts tell you where the price is going. The 3-year forward and 5-year forward tell you where spot is going. So every piece of evidence in the physical market is telling us that prices are going higher. How high? Well, the evidence is suggesting that we're going at least to 130. Besides that, and that is certainly higher than, you could argue, the incentivized price for any development project in the world. So we're going to see a market where incentive price is utterly irrelevant. What is a buyer willing to pay in an undersupplied market for material that they have to have? It's not a material they want. This isn't the new car that you'd love to have. This is something you absolutely need. These are groceries, right? You need groceries. You're going to pay what the supermarket is charging, whether you like it or not. They need uranium, and they aren't going to not buy it because the price is X, Y, or Z. Now, could we get to a place where logically the price means that a utility cannot justify operations? That's possible. And unless we have a balanced market, that might actually be the upside limiting factor. But we've probably talked about this in the past. I've spoken with traders who have spoken with utilities who will tell them, we don't like this market. We know the prices are high. We know they're heading higher. But you know what? If uranium is $200 a pound, I'm not going to like it, but I'm going to buy it if I need it. And that was last year. Okay. So that was last year with uranium at 50. Now uranium's at 80 with ceilings in the 130s. They can't have a non-operational reactor. So I actually have a newsletter member who did his own analysis of, okay, theoretically speaking, what is a realistic price that would keep a reactor from operating? So they averaged out capacity factors. They made an enrichment tails assumption. They figured out, based on uranium being on average 4 or 5% of the overall operating budget of a nuclear utility, they averaged out an assumption of a sales price for electricity. And this was last year, right? And the electricity price has gone way up in the last 12 months. And what they determined was that the price would have to be somewhere in the 700s for the average utility to not be able to afford to buy that uranium in order to operate their facilities. So how high could it go? I really don't know. I'm sorry. I don't have a price target for you. All I can tell you is that it's going higher, and every evidence in the physical market is suggesting that that's the case.
I think that's still helpful. And I love the calculation that you shared. As a non-mathematical person, that always impresses me. So really interesting to hear about. And one small follow-up question there. So you mentioned all the way back at the beginning of this conversation, I think, that the equities were already beginning to recover after this kind of dismal summer that we've had. So that is happening, correct me if I'm wrong, with the price is still not really moving at this time. So what does that tell us about equities performance going forward?
Sure. Well, I think it's a really exciting development, to be completely honest with you. There's there's really one other period of time since I've been following this market where the equities moved without the price moving. And that was the beginning of the bull market, December 2020 through summer, autumn of 2021. The price started to move when spot came on in 2021. But that first move, let's say December to March, April of December 2020 to March, April 2021, was the equities were blowing out to the upside with the spot price not moving. And we're seeing that now. And the spot price is starting to move. And the term price moved up $1 in September, but I don't think anybody could argue that the equities are responding to that. Most of the time, investors or speculators especially don't really pay attention to the term market, even though they should. That's the real market. It's the spot price everybody watches because you get intraday price quotes from Numerico and others. So the spot price flat, the equities moving. They're moving on this news, and the big news stories, of course, are Constellation signing a 20-year power purchase agreement with Microsoft to turn 3 Mile Island Unit 1 back online, which they're going to rename as the Crane Clean Energy Center, at prices of north of $100 a megawatt hour, which is, more than double the existing electricity price. So that's a huge piece, which is telling you this is just more evidence of big tech with deep pockets supporting nuclear. The other piece of news was 14 of the world's largest banks with $14 trillion in assets under management had pledged support for the growth of nuclear. So they're basically saying, we understand nuclear needs to grow significantly. We understand these COP28 goals to triple by 2050, and we're here for it, and we're going to help finance it. And that's a huge piece. That, in my opinion, is even more bullish than the 3 Mile Island news, as bullish as that was, because the banks, the financing risk of building new nuclear has always been a big overhang in the United States. On that note, just this morning, the Department of Energy had a public webinar, which I attended, talking about and sharing a slideshow presentation of a lot of the elements of this liftoff report, advanced nuclear liftoff report, that they initially released last year, and they just updated it. And it's unbelievable what the U.S. Department of Energy is doing to support nuclear. So there's 30 to 50% in clean energy investment tax credits from the Inflation Reduction Act that literally end up cost sharing these projects to that percentage point. So they're basically saying, hey, we're going to foot part of the bill via tax credits to build new nuclear. They're saying that there's 60 to 95 gigawatts of nuclear that could be built at existing nuclear sites. And these are additional power, and at retired coal plant sites. So they're super bold up about this, and they said this morning in this webinar, there's a lot of interest right now for U.S. utilities in AP1000s. So the banks being on board, the tech companies having the cash and needing the power. You had Google come out, you had Meta come out, you had Oracle come out. All of them are talking about nuclear to power data centers. And so you have these massive hyperscaler, like AI hyperscaler data centers that are 1 gigawatt and larger, but you also have non-AI, just cloud storage data centers that's growing equally as fast. And these are smaller. These could potentially be powered by a series of SMRs. Just across the board, electricity demand is growing, not just here. So the equities moving on this fundamental news before the price move is a really exciting thing for me, because that was my experience December 2020 for about 3, 4, 5 month period before the price started to go. The equities were risk on. We're seeing the same thing here. And in the newsletter that we released for this month, 2 days ago, there's a section in it where we basically talked about these developments basically is the crossing of the Rubicon for nuclear. We think this is a fundamental shift for this story and for this thesis. And definitely this is bringing more generalist eyeballs into this story. And that's a very good thing. This is still a very small sector, largely with specialist funds and unique high volatility, high risk appetite retail speculators that come after uranium and precious metals and everything else. But this is going to bring renewed interest from generalists into the space. And the fact that the banks are on board is a huge, huge sign, as well as big tech. So you have a lot of these big tech players, huge tech related podcasts and channels talking about nuclear. it's a growth story now. It's not just a supply constrained story. The demand growth it's gone from 1 or 2%. Now we're looking at 5-6% growth, late decade into the 2030s. It's phenomenal.
Okay, I think that was probably a good place to wrap it up. I always keep you longer than I mean to, so thank you for taking all the time.
No worries at all. I've got time if you have other questions. Yeah.
I do have one more question then. I'm going to throw it in. So we know that the data centers and AI, this has become a huge talking point. Is anyone attempting to quantify exactly how much, or is it really just too early for that? I've also been thinking to myself, like AI technology is so new, at least in the form that we see it today. I have to think that all these big companies are going to be looking at reducing the amount of energy they have to use for it.
So far, trying to reduce energy doesn't seem like it's really something that is a focus. It seems like the tech companies are recognizing the pace of growth and the profitability of pursuing AI, essentially, and growing AI for their own companies. It's hard to say exactly how big this is going to be, but I personally believe that AI is going to become embedded in a lot of the overall kind of day-to-day operations of internet processes. So this is going to be something related to not only just search, like I almost never use Google search right now. I'm using something called Perplexity that aggregates various AI services into search, and it's so much better. It's mind-boggling. Of course, it's using 10 times the amount of electricity that a Google search would, right? So there are some projections. One projection, and I think this might have come from Bank of America. I could be wrong. No, I'm sorry. This wasn't from B of A. This was from an energy analyst, independent energy researcher and analyst in the United States. And I'm forgetting the name. My apologies. But they expect that in the United States, data center demand could reach 9% of overall electricity demand of the United States right now. And currently, I believe it's 3% or 4%. So expecting it to double and potentially almost triple in the next 5 years just in the United States. And that's just the electricity demand for that. There's various projections being thrown out there for how fast this is going to grow. Basically, it's growing so fast that electricity availability is the limiting factor. And so there's a lot of concern amongst the tech companies in consuming so much electricity that it's going to drive up prices for everything and everyone else. Excuse me. This is why we've seen these first deals get done with 3 Mile Island coming back online, because that's not going to be taking current electricity from the grid. It's bringing capacity back online that'll exclusively be powering the data center. The Talon Energy deal, buying electricity directly from the nuclear. It's literally built like you can throw a stick and hit the nuclear plant from the data center. So, and it's also why they're wanting to build new nuclear. Of course, these tech companies, not only do they have enormous visibility to the public in everything that they do, which is why that ESG box is so important for these companies. So not only do they need to project to their customer base that they are powering their data centers with clean energy, they're also filled with, for lack of a better word, environmentally minded, left-leaning employers or employees, right? Thousands and thousands and thousands of people that are not going to be happy about growing coal power or even natural gas, as clean as it is, to power the growth of this. So they're wanting to expand geothermal, they're wanting to expand solar with storage, but they obviously are saying we prefer nuclear because it's firm, it's baseload, and it's clean. So all of these elements are conspiring for a pretty phenomenal picture for nuclear, not just in the United States, but the other countries that have. United States by far has the most data center capacity, but other countries that have significant data center capacity: China, Japan, UK, all very nuclear dependent. China, of course, is building like absolute crazy. They've got 30 reactors under construction right now, 30. Japan, of course, I think they have 2 reactors under construction. They still have got another 20 something reactors that have applications in to the NRA in Japan for restart. Japan is going to, in my estimation, despite the fact they have a steeply declining demographic, they are expecting electricity demand grow. So we think that we're going to see more and more restarts in Japan. I don't think they're going to happen super fast. I don't think that's really that important at this point for the thesis, but countries that have existing nuclear with electricity demand growing for whatever reason, highly de-risking of those fleets, highly likely we see life extensions across the board in those countries.
Okay, thank you for going into that. I'll let you go. Any final thoughts you would leave investors with, though, at the moment, just heading into Q4?
I think we covered it decently well. I would say just keep your eye on the physical market. Don't pay too much attention to fluctuations in spot price, even though that is what is most visible. Do what you can to seek out information on the dynamics of the term market. It's much more cagey with that information. The term market prints only happen at month end, but you can get detail on that from us or from some other folks in the sector as well. And having a network is extremely important to understand these things. So keep your eye on the physical market, watch for the funds flows, and go back and check out, like, chart URNM against the commodity itself, against spot uranium, and you'll see the incredibly steep move that was late 2020 or early 2021 on a relative basis, miners versus the metal. That is starting again, and we're very close to a breakout technically on that chart. So keep your eye on that. Of course, there's a lot of volatility in my estimation that isn't being priced in because of the election year. I continue to think that there's a high likelihood of some kind of disruptive event of some kind in the next 4 to 6 weeks. Knock on wood, I would love to be wrong, I think, but having the 2 presidential candidates have pretty significantly different market implications on their proposed policies adds some uncertainty. So for the next 30 to 60, maybe 90 days, maybe there's some volatility around all of that, but unique for this sector. It's the setup is phenomenal. And like I mentioned, like we already discussed, not many levers left to pull for the utilities. So the term market demand is going to come back. We expect 2025 to be a strong year for volume secured in the term market. And with volume pulling back and the price flat and rising, it's a sign that when volume steps in, it's going to continue to the upside.
Okay, so we've got a lot of different factors to keep an eye out for. Hopefully we have you back soon to go over developments as they happen. But thank you for being here today. This is really good.
It's always my pleasure. Always good to see you and talk to you. Thanks.
Great. And once again, I'm Charlotte McLeod with investingnews.com, and this is Justin Huhn with Uranium Insider. Thank you for watching. If you like this video, make sure to hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.